Hello, my name is Tyler Gargano. My group of Frank Duffy, Tyler Lucian, Ben Gilshinsky, and myself are discussing the differences and similarities between U.S. generally accepted accounting principles, international financial reporting standards, and U.K. generally accepted accounting principles, specifically in regards to the defining of and reporting of property, plant, and equipment, otherwise known as PP&E. I will begin by discussing property, plant, and equipment as defined by U.S. GAAP. Property, plant, and equipment are assets that the company expects to use for either a year or one operating cycle, whichever is longer. Another name for this group is tangible fixed assets. Property, plant, and equipment contain 5 major components, which includes land, buildings, plant or machinery, vehicles, and equipment. These expenditures on these assets are considered capital expenditures. According to current U.S. GAAP guidelines, 4 major aspects of capitalized costs are invoice price of plant paid to a supplier, freight paid to bring plant to the installation site, installation fees and costs incurred upon testing the plant. The significance of capital expenditure is that the recording of the expense is listed on the balance sheet instead of simply being written off against revenues listed in the income statement. The International Financial Reporting Standards defines property, plant, and equipment under the International Accounting Standard 16. This standard defines property, plant, and equipment very similar to that of U.S. GAAP in that PP&E assets will last longer than one operating cycle or a year. According to IFRS, however, items of PP&E are recognized as an asset, which it is probable that both the future economic benefits will flow to the entity and the cost of the asset can be measured reliably. An important aspect of this recognition method used by IFRS is the cost of PP&E assets are applied at the moment incurred. This includes costs incurred in order to acquire or construct the asset, in addition to subsequent costs to add to the asset and to repair service of that asset. IFRS makes the distinction that the asset is purchased on account. The market value interest must be recognized as well.
Next, we will discuss IFRS and GAAP convergence and some accounts that are adapting to IFRS globally. These accounts include inventory and revenues. Convergence started as a concept of harmonization, which came after the economic integration and cross-border capital flows increased following World War II. The goal for harmonization was to reduce differences in principles used in the major allied countries around the world. As differences were reducing, a group founded the International Accounting Standards Committee in 1973. This committee went into effect in many countries including Australia, Canada, France, Mexico, the Netherlands, the United Kingdom, and the United States. Fast forward to the 1990s when harmonization was replaced by the concept of convergence. Convergence, like harmonization, was created to help reduce differences internationally, but convergence had a basis of standards to stand behind for support. All major markets and countries tied to the US and the UN would come under the effect of convergence. The IASC started to improve their rules and create standards since their basis came from an old concept. As time went along, the IASC was then replaced by the International Accounting Standards Board in 2001. At this point in time, the FASB and the IASB have worked continuously to improve and converge U.S. generally accepted accounting principles and international financial reporting standards known as IFRS. This way, international business transactions will not have to deal with completely different standards and business transactions can be completed smoothly. Nowadays, the European Union and more than 100 countries require you to use IFRS or a variant based on the same standards. Japan and China are the most recent countries to start working on convergence and their standards to IFRS. Another important country carrying out convergence is the United States. US GAAP is now very similar to IFRS, but the process is continuing so that international transactions will be easier. As previously mentioned, the 2 accounts that contain differences are inventory and revenue. Inventory under IFRS is separated into 3 cost systems: FIFO, which is first in and first out, LIFO, which is last in, first out, and weighted average method. IFRS uses these cost systems because it helps focus on the balance sheet approach and keeps them away from the income statement. Now we look at revenue. Revenue, which is the gross inflow of economic benefits that occur in the course of ordinary activities, and this can increase the equity in a company. Revenues from the sale of goods are recognized, but only when they meet the following conditions. Significant risks and rewards of ownership are transferred. Revenue amount can be reliably measured. Cost can be reliably measured. Inflow of economic benefits is probable. And no continuing managerial involvement and no effective control over the goods sold is enforced. IFRS will continually work on reducing differences in standards with all the accounts that are necessary to the balance sheet approach.
In the United Kingdom, property, plant, and equipment is known as tangible fixed assets and are defined basically the same as the U.S. defines PP&E. Tangible fixed assets consist of plant, machinery, cars, land, and buildings. I am going to discuss how tangible fixed assets are initially measured and then revalued according to UK financial reporting standards. A tangible fixed asset, whether it is acquired or self-constructed, is to be initially recorded at cost. Only the costs that directly attribute to getting the asset to working condition are counted in the initial costs. Those costs need to be capitalized in the periods that are needed in order to get the asset ready to be used. The company that is reporting these tangible assets have the option to include interest in the reports or not, but it has to be consistent throughout the reports. They can't choose to report the interest in one time and not another. Finance costs are also included in the initial evaluation of tangible assets. When compared to US GAAP, the initial measurement of tangible assets is basically the same as PP&E. The US GAAP states that PP&E should be recorded at all costs necessary to make the asset ready to use during the construction period. A tangible fixed asset is to be reevaluated at the current value on the balance sheet date. This is achieved by executing a full valuation at least every 5 years and performing interim valuations each year. There may also be a full valuation when there is likely to be a material change over the current period. Tangible assets that have a secondary market other than properties are to be revalued at market value. The gains and losses occurred during the reevaluation of assets are recognized in the Statement of Total Recognized Gains and Losses. The way the U.S. reports their PP&E according to GAAP is that they are reported at historic cost. The U.S. doesn't reevaluate the costs of PP&E because of the objectivity in arriving at the current cost estimates.
The final topic that we will discuss are the impact of the convergence between US GAAP and IFRS on different types of accountants and investors across the world. First, the impact on corporate management. Corporate management will benefit from simpler, streamlined standards, rules, and practices that apply to all countries that follow the International Financial Reporting Standards. The change will afford corporate management the opportunity to raise capital via lower interest rates while lowering risk and the cost of doing business. Second, the impact on investors. Investors will have to re-educate themselves in reading and understanding accounting reports and financial statements following the new internationally accepted standards. At the same time, the process will provide for more credible information and will be simplified without the need for conversion to the standards of the country. Furthermore, the new standards will increase the international flow of capital. And next, the impact on the stock markets. Stock markets will see a reduction in the costs that a company entering foreign exchanges, and all markets adhering to the same rules and standards will further allow markets to compete internationally for global investment opportunities. The impact on accounting professionals. The shift and convergence of the current standards to internationally accepted ones will force accounting professionals to learn the new standard and will ultimately lead to consistency in accounting practices across the globe. The impact on accounting standards setters. The development of standards involves a number of boards and entities that makes the process longer, more time-consuming, and frustrating for all parties involved. Once standards have converged, the actual process of developing and implementing new international standards will be simpler and will eliminate the reliance on agencies to develop and ratify a decision on any specific standard, due to the fact that now the entire globe will follow the same accounting standards.